Good morning to all. This is Dr. Gurumurthy Velusamy, Assistant Professor, Department of Commerce. Today we are going to talk about accounting concepts. So in this video, we are going to talk the various accounting concepts such as the entity concept, the money measurement concept, going concern concept, dual aspect concept, accounting period concept, realization concept, cost concept, matching concept, the accounting equation concept, finally, objective evidence concept. The accounting concept can derive in the simple example. If we want to run one computer program means we want to know the particular program code. If suppose any error or any mistake or any ignorance of the code, we are getting only error in the program. As like that, the accounting concept is it is an assumption and the conditions upon which accounting is based. So based on this concept, our accounting system runs successfully. So the term concept is used to connote the accounting postulate, that is necessary assumption and conditions upon which accounting is based. These are the theories on how and why certain categories of transactions should be treated in particular manner. So the accounting concept is just like a program code. So if there is any mistake, our accounting system will be collapsed. So it is very important thing. So let us see what are the categories of accounting concept. First important concept is business entity concept. This concept refers that owner and a company's separate entity. Means the owner put into company as a capital, that time the company is liable to the owner. As well as he is written back from the company as a drawings, which is used for the personal use, that time the owner is liable to the company. Hence, the books of accounts are prepared from the point of view of the business, not the owner. The next one is going concern concept. It is assumed that the entity is going concern, that is, it will continue to operate for an indefinitely long period in future and transaction are recorded from this point of view. So, while we are writing an account for the particular company, we just assume that it is long run, not in the short run. The next important concept is money measurement concept. Whatever happen, we have to write an account while in the journal or ledger, even the trial balance and final account, it should be based on the money value. So without money value, we are not supposed to write any transaction for the particular accounting system. So in accounting, a record is made only of those transactions or events which can be measured and expressed in the terms of money. Hence, non-wanted transactions are not recorded in accounting system like innovativeness, attitude, experience, skill, honesty, teamwork, passion. These are all not recorded in our accounting system. Next, accounting period concept. Though the company run in the long period, it should be measured in the particular separate period. For measuring the financial result of the business periodically, the working life of an undertaking is split into convenient short periods called accounting periods. Generally, the business activities keep going, but accountants have to draw and line somewhere. That means all the accountants can take in the separate period. That means the 12 months, which is starts from April to March. This is financial year. All the companies has been followed for a particular month. That is annual accounting report. And next, cost concept. An asset acquired by a concern is recorded in the books of accounts at historical cost, that is, at the price actually paid for acquiring an asset. The market price of the asset should be ignored, which explained here. If you are purchased one computer in 2010 at $555, the historical cost shows in 2010 555, in 2011 $555. But in the market value of the particular asset in 2010 $555, but 2011 $250. It has been decreased so that the concept tells us we want to write based on the historical cost, not in the market value of the asset. The next most important concept is dual aspect concept. Every debit there is a credit. Every transaction have a two-side effect to the extent of same amount. For example, if the cash sales made rupees 10,000, we want to write cash account debit to sales account the same amount 10,000 and 10,000. The next thing is realization concept. The profit is earned when the goods or service are provided or transferred to customers. The revenue should be recognized only when it is legally due and realizable. So, while the cost is realized, then the revenue can be realized. And next, matching concept. The matching principles ensure that revenues and all their associate expenses are recorded in the same accounting period. Hence, the outstanding and prepaid expenses incomes have to be properly adjusted. The matching concept refers all the expenses, all the incomes have to be recorded in the proper accounting period. If there is any outstanding, we have to add it. There is any prepaid, we have to deduct from the particular items. And next, this is very important concept, accounting equation concept, which shows asset equal to liabilities plus owner's equity. If it is possible, then only the final accounts, the balance sheet can be tallied. So based on the accounting equation concept, the balance sheet should be tallied. Finally, objective evidence concept. All accounting entries must be based on objective evidence. It refers verifiability, reliability, and absence of bias. So all the transactions should be recorded based on the evidence. Without evidence, we are not supposed to record in the journal entries. So these are then theories of or principles of accounting concept. Based on that principle, the entire accounting system have been running successfully. Thank you.